Welcome back to the deep dive. You know, some companies just seem to dominate. Like for years and years, they just stay on top. We're diving into the world of investing to figure out their secret. It's all about economic moats. And we're using the little book that builds wealth to help us out. It's by Pat Dorsey. We'll break down how these moats work and why they're so important for investors, like you guys.
Okay, think of it this way. You're building a castle, right? You wouldn't just have, strong walls and a big, tough gate.
You need a moat to keep out all those raiders.
Exactly. A moat is like extra protection. Makes it almost impossible for, enemies to get in.
I'm with you. Makes sense.
It's the same for businesses. An economic moat protects them from competition, lets them make big profits, for a long time. It's built into the company's foundation. It's not just luck.
So instead of just focusing on what a company makes or who the CEO is, we need to look for these deeper things that create a moat.
Exactly. Dorsey busts some myths about what a moat really is. You might think a super popular product means a company has a moat.
Yeah, sure. Remember those fidget spinners? They were, everywhere.
And then poof, gone. Taste change, technology changes, and yesterday's big thing is tomorrow's junk. A real moat. It's about lasting advantages.
So what about just being huge?
Yeah.
Like the biggest in your market? That has to be a moat, right?
It might seem like it, but even that doesn't guarantee a moat. Think back to Kodak. They, owned film photography.
Totally.
But then digital cameras came along, and they just didn't adapt. Being big only matters if you got there the right way.
Right, the right way. Okay, so size isn't everything. What about, those companies that are all about efficiency, cutting costs, being super lean? Is that a moat?
Being efficient is great, but anyone can copy that, unless it's based on something really unique.
So if all you're doing is cutting costs, someone else can do the same thing, or even better. Then what?
Exactly. Dorsey also says having a, rock star CEO, that's not a moat either. A great leader helps, but they won't be there forever. A company with a real moat, it can do well even with an average manager.
So it's about those advantages that are built into the business, not just trends or personalities.
Right. Dorsey breaks it down into 4 categories. Intangible assets, switching costs, the network effect, and cost advantages.
Sounds good. Let's break them down. Intangible assets, what are those?
Things you can't touch but are super valuable, like brands, patents, and regulatory licenses.
Okay, yeah. A strong brand, that definitely gives a company a boost. I'll pay extra for that coffee with the mermaid, even though I could get a cheaper one somewhere else.
That's it. It's about perception. Dorsey talks about USG sheetrock. They sell wallboard. Basic stuff.
Yep.
Their product's basically the same as their competitors, but they charge more. Why? Because they've built a reputation for quality.
So even if the actual product is the same, a brand makes people think it's better.
Got it. What about patents?
Patents are a great moat, especially for pharmaceuticals, where research costs a ton, but patents expire.
True.
So then what happens? Competitors can jump in with cheaper versions.
So you have to think about what happens after the patent runs out. Exactly. A good investor looks beyond the patent.
Okay. What about those regulatory licenses? How do those create a moat?
Imagine a town with only one cable company.
Oh, yeah.
They're a monopoly. Because it's hard for other companies to get in, so they can charge what they want. Boom, moat.
Okay, let's try to get how these intangible assets work. But let's move on. Switching costs.
This one's all about making it a pain for customers to go to a competitor. So inconvenient or expensive, they just stay put.
Ooh, yeah. I tried switching accounting software recently. What a nightmare. Moving all the data, learning a new system.
Exactly. QuickBooks, that's a classic example. If your whole business depends on it, switching is a huge project.
They've got you trapped.
And banks are the same. Hate changing accounts. Even manufacturers use this.
Dorsey talks about precision cast parts, right? Making parts for jet engines.
Yep. When a mistake could be a disaster, you pay for reliability.
So switching costs can come from lots of things. Data, inconvenience, or just plain fear of messing up something important.
Now, let's talk about the super moat, the network effect.
Super moat. That sounds serious. What's that all about?
It's when a product gets more valuable, the more people use it.
Like social media. If only a few people are on a platform, it's boring.
But add more people, more sharing, and it gets better for everyone.
Classic example is eBay, right? More buyers, more sellers, more stuff to buy and sell.
Exactly. But even eBay struggled in some places. Shows you need to understand the market and get in early.
So timing and knowing your customers, that matters too. What else did Dorsey talk about?
Financial exchanges. The NYSE, NASDAQ, more companies list there, more investors come, more trading happens.
It just keeps growing.
But futures exchanges, they're even more profitable because they're closed networks. You have to go through them to trade certain contracts.
So it's like a moat inside a moat.
Exactly. Closed versus open networks, that's a key concept.
Okay, intangible assets, switching costs, network effect. We're on a roll. Last one, cost advantages.
This one's tricky because cost advantages can disappear. Like just moving production overseas for cheap labor, that's not a moat.
Someone else can always do the same thing.
Right. It's about having a cost advantage that's hard to copy.
What are some examples of that?
Well, Dorsey talks about process advantages,
Yeah.
like Dell selling computers direct to consumers, cut out the middleman.
But why didn't other companies do that right away? Seems like a no-brainer.
They were too tied to their old ways of doing things with retailers and distributors. They couldn't just switch overnight.
They were stuck. What else?
Scale. Think Walmart. They buy so much stuff they can get the best prices.
Bulk buying on a massive scale.
Exactly. And finally, there's niche domination. You don't have to be huge, just the biggest in your specific market. Like Graco, they dominate a certain type of industrial pump.
Maybe not a household name, but they're the kings of their little world.
That's the thing with niches. You become the go-to, even if you're not that big overall.
Okay, part one down. We defined economic moats, busted some myths, and went through the 4 types of moats.
And in part 2, we'll see some real-life examples of moats at work and how they can be threatened over time. So are you ready to see these moats in action? Real-world stuff.
Definitely. I mean, the theory's cool, but seeing how it works in the real world, that's what gets me excited. Dorsey looks at some really interesting companies in the book. Like, does this company have a moat? How strong is it?
Yeah, and he says this process, it's not just science, it's like art too, no magic formula. But the ideas we've talked about, they give you a good way to look at businesses.
One company that really struck with me was Arch Coal. Coal mining. Not exactly what you think of as a moat-worthy business, right?
No.
Seems like just a plain old commodity.
You'd think so, yeah. But get this, Arch Coal controls a big chunk of the Powder River Basin. In that area, it's got some of the cheapest coal production in the U.S.
So even in a basic industry like coal, there can be hidden advantages.
Exactly. It's not always the product, but the things that give a company an edge. Arch Coal, their cost advantage, it's huge.
But I remember reading something about them having old contracts, priced really low, so their profits didn't look that great.
Right. Those old contracts kind of hid their true profitability. But as those expire, new ones will be priced higher. And then, bam, you'll see how strong their advantage is.
So the moat was always there, just kind of hidden. But Dorsey still calls it a narrow moat, right?
Yeah, because coal, it's still affected by things outside the company's control. Production costs, government rules, and, well, the whole world's moving towards cleaner energy.
Makes sense. With cost advantages, you got to be careful. Things change fast in those kinds of industries. Another one that was interesting, Fastenal. They distribute like nuts, bolts, fasteners. Not the most exciting stuff.
True. But Dorsey says there's beauty in the mundane, especially in investing.
I like that.
Fastenal, they've got this massive distribution network, over 2,000 stores, like twice as many as their closest competitor.
And those things are heavy, expensive to ship. So being close to the customer, that's a big deal.
Huge. When a factory line stops because they're missing a tiny bolt, they need it now. Fastenal can often deliver the same day. Nobody else can do that.
So it's scale and speed. Dorsey calls it a wide moat.
Yep. To beat Fastenal, you'd need all those stores, and you'd have to go into all the small, less profitable markets where they already are. Just too expensive to copy.
Amazing how a simple business can build such a strong moat, just by doing things really well and focusing on what customers need.
But not all moats are equal. And Dorsey shows us how even a strong moat can disappear over time.
Yeah, he talks about Pier 1 imports and Hot Topic. Both were doing great in the early 2000s. Profits were up. But then,
If you look closely, their success wasn't built on anything solid. They were just riding trends. Imported furniture for Pier 1, teen fashion for Hot Topic.
those trends faded. Tastes changed, more competition came in, and their profits tanked. Their moats were like sandcastles.
Exactly. Even when a company looks successful, you gotta ask, why are they making money? Is it a real advantage or just a fad?
Dorsey really makes you think about moats as something that can change. They can get bigger, smaller, even vanish as industries evolve and competition heats up.
Right, and he's got a whole chapter on what can hurt a moat. A big one, we see it everywhere, is technology.
Tech can really shake things up, creates new opportunities, but also destroys old moats.
Like Getty Images, they had a huge library of stock photos and a whole system for licensing them. Seems like a strong moat.
Totally. They were the source for high-quality images.
But then the internet changed everything. Suddenly, tons of images were online, cheaper and easier to get. Getty lost its pricing power because customers had other options.
Wow. Classic case of technology disrupting even the big players. Their moat was breached by the digital world.
And it's not just tech companies. Any business that uses tech can be disrupted.
Right. Tech is everywhere. Dorsey also mentions customer consolidation as a threat. Like what happens when a few big buyers control an industry?
Think Walmart and Home Depot. Suddenly, companies selling stuff have to deal with these giants. They can demand lower prices, squeeze profits.
It's like the power shifts in the industry. The manufacturers lose their leverage.
Exactly. Dorsey also warns about irrational competition. What if a company doesn't care about making the most profit?
That would mess things up, wouldn't it?
For sure. Like state-backed companies. They might be okay losing money or slashing prices just to grab market share. Even a company with a great moat would struggle against that.
So you can't just look at your competitors. You have to understand the whole game and watch out for players who aren't playing by the normal rules.
Absolutely. Figuring out how strong a moat is and how long it'll last, you need to look at the whole picture. The industry, the competitors, and the things that could change the game.
So we've covered how to spot a moat, how strong it is, and what can make it weaker. But there's one big thing missing: valuation.
That's right. Even the best moat in the world won't make you money if you pay too much for the stock. In the final part, we'll see how Dorsey figures out how much a company is worth, so you don't overpay, even for a great business.
Okay, so we've learned how to find a moat, see
Yeah.
how strong it is, and we've seen how they can be threatened by, like, technology, changing power dynamics, all sorts of things.
Right.
But the big question now is, how much is a moat worth?
That's where valuation comes in. You could have the best moat ever, but if you paid too much for the stock, you're not going to make money.
Makes sense. Because the stock, it's just a small piece of a company, right?
Exactly, like buying a brick in a castle. The brick's only worth something if the whole castle is valuable.
Okay, I get that.
And a business, its value comes from all the cash it's going to make in the future.
So it's not just about what they're earning now, but what they'll earn later.
Exactly. And that's why moats are so important. A company with a wide moat, it's more likely to keep making money because it's got that protection from competition.
But how do you actually figure out what a company is worth? Seems complicated.
It is. Dorsey says there's no one perfect way to do it. It's a mix of art and science.
He mentioned some tools, like price multiples, comparing the stock price to things like sales, earnings, or book value.
Yeah, those are the ratios you see all the time. Price to earnings, price to sales, all that.
But you can't just use them without thinking. Right?
Exactly. You got to consider the business, the industry, and how fast the company might grow.
A high price to earnings ratio. It might be fine for a company with a great moat and tons of growth potential. But for a company with a weak moat, that same ratio could be a warning sign.
Exactly. It's not about finding the lowest multiple. It's about understanding what it means.
Okay, so context is key. What other tools are there?
Dorsey also talks about yield-based metrics, good for comparing stocks to bonds, like the earnings yield. It's just the inverse of the price-to-earnings ratio.
So if a company has a PA ratio of 20, its earnings yield would be 5%.
You got it. It tells you how much return you're getting based on what the company is earning right now.
Interesting.
Then there's cash return. It's a little more complex. Takes into account debt and what the company spends on equipment and stuff. It shows you how much cash an owner could actually take out of the business each year.
Like if you own the whole company, this is how much cash you'd get.
Exactly. And the nice thing about these yield metrics, you can compare them directly to bond yields. So you can see if a stock looks cheap or expensive compared to a bond.
So it's about balancing risk and reward. If you think a company is going to keep growing its profits, a higher earnings yield might be good. But if you want something safer, maybe a lower yielding bond is better.
Exactly. It all depends on your goals and how much risk you're comfortable with.
Makes sense. Dorsey gives some good advice for using these tools. Like, he says growth is great, but it has to be profitable growth.
Right. Don't get fooled by companies that are growing super fast but burning through cash. Look for companies that can grow and make money at the same time.
He also warns about getting caught up in the hype of story stocks.
Yeah. The market sometimes gets carried away, pricing in crazy expectations. You got to see past the hype and focus on companies with solid moats and a track record of success.
Don't get swept up in the excitement. Stick to the fundamentals.
Exactly. And use multiple valuation tools. Don't just rely on one. Double-check your work. Make sure you're not missing something important.
Okay, check and double check. Got it.
And lastly, Dorsey says patience is key. Good investments take time to work out. Don't panic and sell just because a stock isn't shooting up right away.
Don't freak out over short-term stuff.
Right. The market can be irrational. Sometimes even the best companies are undervalued. Those are the times to buy, when everyone else is scared.
Wow, this has been a fantastic deep dive into the little book that builds wealth. Economic moats. They're essential for finding companies with a lasting advantage.
You're right.
We've learned how to spot them, how they can weaken, and how to figure out if a company's actually worth the price.
Yep. You've got the tools now to look past the hype and focus on what really matters. Find those companies that can build real, lasting wealth.
Thanks for joining us on this deep dive. Remember, keep those mental shovels ready. There are economic moats everywhere. And now you know how to find them.